Welcome. In this session, I'd like to look at sampling questions and issues that we often run into in finance and investing. Let's start with the most common sampling that you're probably going to encounter in investing. When you look at a market, often the way you look at how the market is performing is through a market index. Now, all market indices tend to be samples because they're subsets of the stocks that are publicly traded. Now, let's be very clear, these samples are not random, and these samples are picked by people based on criteria. Now, often the reason we look at indices is to make broader judgments about stocks in general, and how well these indices do in measuring how equities are performing depends on first how many constituents there are in your index. I mean, take the US, you can have an index of 30 stocks like the Dow 30. The S&P 500, which obviously has 500 companies. You have the NYSE, which includes every traded stock on the New York Stock Exchange, or the NASDAQ, which includes every traded stock on the NASDAQ. You can even have the Wilshire 5000, which includes 5,000 publicly traded stocks. A big sample, but still just a sample because there are more than 5,000 publicly traded stocks in the US. Second, it depends on what criteria we use to pick those stocks. I told you the S&P 500 has 500 stocks, but those 500 stocks are picked with a very specific criteria in mind. They're based on market cap. These are the 500 largest market cap companies. If you're looking at other indices, the criteria can get a little more dicey, especially on indices like the Dow 30, where people pick subjectively, and they tend to pick large companies to be around a long time, but it's not as clear-cut. It also depends on how you weight the stocks that go into your index, because whether that represents the larger population depends on whether you're weighting the stocks equally. Are they weighting them based on market cap? So what goes into the index, what criteria we use to pick those stocks, and what weights attached to them. So market indices are never random samples. They're systematic samples. They're non-random samples based on criteria. And that's neither here nor there. I'm not stating that as a critique of market indices, but to point out that they can often capture very different segments of the market. On this page, I have a listing of equity indices in the US. I started the Dow Jones Industrial Average, still the most widely talked about and referenced index in the US. Why? Because it's been around a long time. I think the Dow was first published in 1896. It went to Dow 30 in 1928. So we have history behind the index. We have other Dow indices, the Transportation Index, the Utility Index. There's a Total Stock Market Index. There's even a Barron's 400 Index. They all come from Dow Jones. S&P has its own share of indices, and I've just listed a few of them. The S&P 500 is the 500 largest market cap companies. You've got the S&P 600, which is small cap companies. You've got S&P mid cap 400, which is mid. You kind of get the picture. Each of these indices has been constructed with specific criteria. Is one index better than the other? Depends on what you're reading from the index, what it tells you. Because the bottom line is these indices capture segments of the market. And since they're not random samples, they're capturing specific segments, they can sometimes move in different directions, or at least in different proportions. Take a look at what happened in 2020 to three indices. The Dow 30, that's a green line. You've got the S&P 500, which is the purple line, and the NASDAQ, which is the red line. All three had a bad 6 weeks in February and March. All three recovered, but look at how divergent the recoveries have been. The NASDAQ recovered a lot more, did much better in 2020 than the S&P 500 or the Dow 30. Now, if you think about what causes them to be different, the difference between the Dow 30 and the S&P 500 is because the S&P 500 is the 500 largest market cap companies. Whereas the Dow 30, as I said, is 30 large companies picked non-randomly by editors of who essentially bring their own criteria to play. But the NASDAQ is a different beast altogether. It has lots of stocks listed in it, but it's an index that's dominated by tech companies. What you're seeing here is the divergence of the tech sector from the rest of the market. The tech sector performed much better, and the NASDAQ captures the tech sector much more completely. The NASDAQ did better. I'm not suggesting that you should invest in the NASDAQ because it is tech stocks. I'm just saying when you get divergence across indices, it's often because the samples that they represent are different segments of the market. Now, for a long time, we used indices just to get information about markets. How are markets doing? Are they up? Are they down? Starting about 30 or 40 years ago, we started investing in indices. The earliest of these indices showed up in the 1970s when Vanguard created the first index fund. In about 25 years ago, you started to see exchange-traded funds added to the mix. Both index funds and exchange-traded funds are viewed as passive investing vehicles. Why? Because you don't pay somebody to pick stocks, you just try to capture what the index is doing. And one of the things that's true over the last decade in particular, but happening over a much longer time period, is passive investing has grown dramatically, often at the expense of mutual funds and hedge funds and other active investing vehicles. So a lot of people invest in index funds, a lot of people invest in ETFs. And over the last 50 years, the choices have proliferated. In 1973, if you wanted to invest in an index fund, it was the Vanguard 500 index fund or nothing. Today, if you want to invest in an index fund, you have dozens of choices. Some try to track the S&P 500, some track the S&P 600, some track value stocks, some track growth stocks. Some of these index funds hold the entire population. So most S&P 500 index funds hold every stock in the S&P 500. But Vanguard also offers an index fund that supposedly tracks the whole market. The whole market is about 9,000 stocks. Now, the total market fund, the index fund that Vanguard runs, doesn't own all 9,000 stocks. It owns a sampling of those stocks. Similarly, you have exchange-traded funds or index funds that track specific sectors. There are energy ETFs that supposedly track how energy stocks are doing. But if you look across energy ETFs, you notice that they often perform differently, and the reason is very simple. Each of them samples energy stocks. They don't hold all energy stocks. And as a consequence, you can have, in this case, 5 different funds, all claiming to be energy funds. And the returns are going to be different because the sampling they do is different. For instance, the Vanguard Energy Fund has 171 stocks. It's a much bigger sample. And its criteria are different. It leads the Vanguard Energy Fund to have a different composition and different returns than what you get from the iShares S&P Global Energy Fund. So what I'm trying to say here is you can have ETFs and index funds that claim to track an index. Sometimes they hold everything in an index, but often, especially when you're looking at the newer ETFs that try to capture subsegments of the market, you're looking at sampling. And you need to be aware at least of how the sampling is done. What are the stocks that the energy select sector SPDR is holding? How are they weighted? Are they weighted equally? Is one weighted more than others? If so, how are the weightings determined? Because those will determine what the returns on these funds will look like. Now, another way in which you see sampling in finance and investing is because stocks have been traded for a long time. You'll often see people pick a sub-period to look at a particular stock or the overall market. Why do we do that? Because data might be unavailable for earlier periods, or you think it's unreliable. One reason, for instance, a lot of the data on US stocks collectively starts in 1926 is prior to 1926, it's much more difficult to get to the raw data. So people throw up their hands and say, you know what, much more difficult to do, so I'm going to ignore it. There were returns before 1926. We're choosing to ignore it because we don't think they're reliable or the data is more difficult to get. In some cases, we look at sub-periods because we think the market has changed structurally. There are people who believe that 2008 was a structural change in financial markets and that any phenomenon you should be looking at should therefore be post-2008. Now, we can disagree with them, but you can see why they look at 2008 through 2020 but don't go earlier. Or you might be looking at a sub-period because you're trying to test a specific hypothesis about the period. For instance, the hypothesis you might be testing is how do markets do during periods of high inflation, or how do different stocks do during periods of high inflation. Now, one of the few periods of high inflation we've had in the US is the 1970s. So your research might focus on the 1970s because that was the only period with high inflation where your hypothesis can be tested. So let's take an example of time sampling. Now, one of the most widely used metrics to look at whether stocks are cheap or expensive is PE ratios. Now, we all know how the PE ratio is computed. You take the price and you divide by earnings, usually the earnings in the last 12 months. That's in fact what you see in the first column. Now, there are people who push back and say the earnings in the last 12 months might be too high if the economy is doing well, or too low if you had a crisis like COVID. So sometimes people take an average earnings over the last 5 years or the last 10 years. They call it normalized earnings. Normal is just a subjective judgment you're making, but it's an average earnings. That's a normalized PE. So if I divide the price today by normalized earnings or average earnings over the last 10 years. A CAPE is actually a more recent invention where, in addition to looking at history, you're also adjusting for inflation, and you're saying, you know what, if you adjust for the fact that earnings inflation has occurred over the last 10 years, earnings from 10 years ago is worth a lot more than earnings today in today's dollar terms. Well, cutting this discussion short, I have, in this case, 4 different PE ratios for the market. For comparison's sake, I've also thrown in what's called a bond PE. I know you've probably never heard of it, but a bond PE, what you do is you divide the 10-year T-bond price by the coupon rate on the bond. And obviously, if interest rates go down, the bond PE jumps. But in this particular graph, I have only PE ratios for stocks. Now, what does this tell me? Well, if I were purely sticking to the facts, it's giving me the history of PE ratios in the US going back to 1960. You can see the PE ratios in the 70s were very low. They shot up in the 1990s in the dot-com boom. There was a correction. The correction brought us back down. 2008, there was another correction. And since then, we've been in a recovery. But PE ratios today are higher than they've been historically. That's a statement of fact. The PE ratio at the start of 2021, no matter what your definition of PE is, traditional PE, normalized PE, CAPE, Shiller PE, they basically are higher than before. Now, to go from that fact to a judgment about whether stocks are underpriced or overpriced, you're making statements about what you can extrapolate from the sampling data. Can I use the average PE over the entire period? In this case, that's 16.61 as my predictor for the right PE for the stocks. Well, the answer to that is probably not. Probably not. Partly because we're violating all kinds of assumptions about sampling, right? The data is not independent, it's not identically distributed, and it's not controlling for the fact that T-bond rates are changing over time. But this is a sample. It's a sample of data, and people often use historical data to make judgments about the future. All I'm saying is be careful, because there are estimates you can make from the past, but whether they can extrapolate into the future depends on where you are in time and how different the structure of the market is at the point that you're looking at this number relative to what it used to look like in the past. Now, incidentally, a great deal of what we do comes from looking at a particular period of time where something might have happened and extrapolating from that into the future. I'll give you a very simple example. In the late 70s, the early 80s, academics in finance started looking for what they called empirical irregularities. And it's a fancy way of saying we're going to look to see what kinds of stocks seem to earn higher or lower returns than they should given our models. Now, the hubris of assuming your models are right is at the base of all these statements, but that's okay. In 1981, in one of the first and perhaps one of the most highly quoted studies in finance, Rolf Bunce did a study where he showed that small cap stocks with small market capitalizations, earned significantly higher returns than expected than the average stock, than large cap stocks, after adjusting for risk and market performance. It was called the small cap premium. That small cap premium became the basis for all kinds of practice, not just in academia, but in the practice of investing. In investing, people tried to load up more on small cap stocks, expecting to get the same premium in the future. People valuing companies were asked to add a small cap premium to their discount rates. In other words, when you're valuing a small company, you said, add that small cap premium, and often the number they used looked at the historical data. You're saying, so what? Well, that small cap premium comes from historical data. Now, remember, the Rolf Bunce study came out in 1981. In 1981, if you'd stopped and looked at returns from 1927, and why do we start in 1927? Often because, that's where the reliable data was accessible. From 1927 to 1980, did small cap stocks do better than large cap stocks? Absolutely. After adjusting for risk, small cap stocks earned about 6.56% more than the market. There, you got your small cap premium. So was Rolf Barnes right in 1981 when he said those small cap premium? Absolutely. But we're in 2021. People are still using a small cap premium based on historical data. And if I go all the way back to 1927 and look through 2020, it is true small cap stocks through 2020 are doing better than the market, not as well as they were in 1981. But they're making about 3.5%. That becomes the premium that many analysts are asked to add to their discount rate as a small cap premium. But before you do that, take a look at this graph again. Look at what's happened since 1980. If you look at the returns since 1980, small cap stocks since 1980 have earned 0.56% less than the average stock. There is no small cap premium anymore, at least if you look at the last 4 years. Sometimes long time periods can be deceptive because what you're finding reflects what happened over the whole time period. But if there's been a shift across time, you might be missing it. We'll come back later in the context of talking about investing and talk about the small cap premium. But you can already see that this is a statistical question. Do small cap stocks earn more than the market? Well, if I go all the way back to 1927, I can state as a fact and even as an estimate and even perhaps as a fact that small cap stocks have done significantly better than the market after adjusting for risk. If you ask me, can I use a small cap premium going forward? I'm going to be more cautious about extrapolating that finding because of what I see in this graph. So that's it's a question of time sampling, and be aware of that when you look at findings either from academia or practitioners about something that beats the market. Take a look at the time period and then think about, is there something happening over the time period that should make me more cautious about jumping in? As I said, in investing, the constant search is on for investment strategies that beat the market. Can I buy low PE stocks and beat the market? How about low price to book stocks? How about stocks with high dividend yields? And oftentimes when you get these strategies, people try to backtest these strategies. If I'd adopted this strategy, would I have made money in the past? I know it's backward looking, but it's a good way to start to see whether you should be trying it. So let's take some of the most widely tested investment strategies in history. Over time, people have believed that value stocks beat growth stocks. And I'm going to use a very lazy categorization of value and growth, at least from the early research. Low PE and low price to book stocks are value stocks, and high price earnings and high price to book are growth stocks. I know it's simplistic, I know it's lazy, but one test that was run through much of the 20th century is if I bought low PE stocks, would I earn higher returns after adjusting for risk in the market than if I bought high PE stocks? And the answer for much of the 20th century was absolutely. Low price earning stocks and low price to book stocks earn significantly higher returns than high price earnings and high price to book stocks. Now, whenever you look at studies like these where people are classifying stocks based on observable characteristics, price earnings ratios, price to book, dividend yield, here are three questions that I think you should ask. The first was, what was the universe of stocks from which you created these classes? So when you say these are the lowest PE and these are the highest PE, did you look at all stocks that were listed, only stocks in the New York Stock Exchange, only the S&P 500? Because that can create bias. Because if you start with the universe of only the S&P 500 and tell me these are the smallest companies, the lowest PE companies, you're looking at low PE, large market cap companies. So I need to know what the universe is. What is the basis for the PE classes? Did you divide price by earnings in the most recent year, earnings over the last 10 years? I need to know that. And I need to know what you did with companies with negative earnings. Because remember, when you use PE ratios, stocks with negative earnings have PE ratios that are not meaningful. Often they get removed from the sample. If that's what you did, that's a little worrisome because there's sampling bias you've introduced by removing negative earnings companies. In fact, one reason why careful researchers don't use PE ratios is because of that problem. What they use instead is the earnings to price ratio, where negative earnings companies can be left in the sample. The second question I'm going to ask you is about survivor bias. So when you look at stocks and how they've done between 2010 and 2019, here's what I hope you did. I hope you went back to 2010, looked at every publicly traded stock then and created your classes based on PE ratios in 2010. As opposed to what? As opposed to starting with a database of companies that were still around in 2020 and had been around since 2010 and working backwards. Because if you do that, you've created survivor bias, because you're then not even considering what happens to companies that might have had low PE ratios in 2010 but went bankrupt in 2014. So how did you come up with these samples? Did you include all the companies at the start of each period? If you did not, you're going to create survivor bias. And third is you're looking for timing bias. When you look across these decades, you can see depending on the decade you're looking at, the difference varies. The best decade for value stocks was the 1970s. Any study that starts in 1980 on value stocks is going to find much weaker results than one that starts with 1970. Any study that ignores what happened since 2010 is going to find value stocks did better than one that includes the last decade. So timing can create bias, and often the way studies are set up can also create bias from survivorship and from sampling. There's one final arena where you will see sampling play up, and that's in what are called event studies. Let me explain. An event study is when you want to see what happens around an event, an acquisition, a bankruptcy. Basically, you're trying to say, hey, can I take advantage of an event happening to make money? Let's take acquisitions. Let's suppose your strategy is you want to try to make money by buying a stock right at the time an acquisition is announced. There have been dozens, perhaps even hundreds of studies that have looked at how stocks do around acquisition announcements. This is one study. I'm not saying it's the best study, but it's a study, and I want to use the study to illustrate some of the questions you will ask about any event study. So in this study, what the researchers did was they took a bunch of acquisitions, and we'll talk about where the bunch was because there can be sampling issues that come up. They looked at what happened around the acquisition date. So date 0 is the date the acquisition is announced. They looked at the 6 days before the announcement, the 6 days after, and they tracked the returns in the stock. And guess what they found? They found that returns tend to jump not on the acquisition day, but starting about a day before the acquisition. We'll come back and talk about why that might happen a day before, and then they jump and then they level off very quickly one day after the acquisition. So almost all of the return happens around the acquisition day, starting just before, ending right after. So this study at least concludes that on average, if you look at the returns that acquirers make, so this is looking at the acquiring companies, not at the target companies. It looks like acquiring companies are rewarded by the market for doing acquisitions. It's not monumentally large. You make about 1.5%. Now, before you extrapolate from this study, of course, you got to stress test it. So first question you want to ask is, hey, which acquisitions did you look at to come to this conclusion? In this case, the acquisitions were 51 acquisitions between July 2012 and May 2013 on the London Stock Exchange. Okay? That's a particular time period. You always worry about studies that are over a short time period because if there's something else going on in the market that could explain this behavior, it might have nothing to do with acquisitions. Were there only 51 acquisitions that happened, or were there 250? My guess is there were more than 51 acquisitions, but these 51 were picked for whatever reason. The data was available, it was accessible. So it's good to first look at, how was the sample created and what are the biases that come from how it was created. In terms of timing questions, this study is premised on the notion that you know what the announcement date is. And often many of these studies look at announcements that show up on the news wires but is that the actual announcement date, or is there some leakage that happens? With 3 days before the actual announcement date in the exchange, it's pretty well known in the market that the acquisition is going to happen. So it is entirely possible that if the acquisition date is not nailed down, what you're seeing as a run-up before the acquisition date just reflects leakage of information. These are statistical questions. How is the sample created? How is date zero defined? Is there any messiness in that definition that can affect your returns? We'll come back and talk a little bit more about event studies in the context of my investment philosophies class. But many of the challenges you face in empirical research and finance is looking past the findings, which might be compelling and things you want to act on. But before you act on and asking questions about sampling and survivor bias and timing, and you might say these are statistical questions, but they cut to the heart of whether you can act on those findings. So sampling is all over finance and investing. And I think in some cases the samples can be random, but in most cases they're systematic. It's very seldom that you see random sampling in finance, which also means that when you look at findings, you got to be careful about how you extrapolate. So if I tell you that I found something by looking at S&P 500 companies, you have to be careful about not extrapolating from that to all US companies, because the S&P 500 is large companies. You can extrapolate to large US companies, but you might not be able to extrapolate to small US companies or to non-US stocks. I hope you found this session useful, and thank you very much for listening.